Hello, everyone. My name is Corey Daharsh, and I am here with Advanta IRA to bring you this webinar on some of the most unique investments we've seen our clients partake in. And I'm also going to share some general information about how you can apply your investment goals and strategies in your retirement dollars to some unique ideas yourself. Again, I'm Corey Daharsh. I've been with Advanta since 2016. I've worked in a number of different roles with the company, starting out processing transactions in the accounting team in the back office, then moving to being a client account manager, serving clients day to day with their questions, concerns, executing transactions, and things like that. And I was in that role for about 5 years until about 3 years ago, when in the middle of the COVID pandemic, I decided with my wife to move and live remotely. At that point, I switched over to the business development team where I now work and educate and network to just share and expand people's knowledge and understanding of self-directed accounts. So if you have any specific questions outside of today's webinar, please feel free to take down my contact information. I'll have it up on the screen again towards the end of the presentation if you don't catch it now. And also, you'll be receiving, if you've signed up, a copy of this webinar within about a day or so. And if you're interested in the PDF of the slide deck, you can access that in your GoToWebinar panel. There is a button labeled Handouts. I've already uploaded a PDF of today's presentation there, so please feel free to pull that if you're watching with me live. I do want to encourage audience participation, but you will be muted for the duration of today's webinar. So please use the questions box. I will review that periodically, answer your questions as long as they relatively relate to the presentation. If they're too far out of the presentation scope, I will address those separately. So please just address them as you see fit. Reach out with questions in the questions box, pull the handout if you'd like the PDF, or just wait about a day and you'll receive a copy and a link to our YouTube hosting of this webinar where you can watch it back at your convenience, pause it, rewind it, fast forward it as you deem necessary. And without further ado, I'm going to start with some general information about Advanta IRA before I go into some of these investments and then the structures that these investments are coordinated through. So Advanta IRA is a self-directed retirement account administrator. We've been in the industry for about 20 years. We've got a little over 10,000 active clients right now and just over $2.5 billion in assets under management. Each client of Advanta is partnered with a dedicated client account manager. That role that I referenced, I had served for a few years. That person is going to be a go-to point of contact so that you don't have to reach out to a large wire center or call center and just not know who you're speaking with every time and have to explain who you are and what you're trying to do each time. You build continuity with your account manager, and we really do this to set ourselves aside from some other companies in the industry so that we're really giving a white glove approach and a concierge style customer service to our client base. I do want to express that as a self-directed administrator, we are not allowed to convey any tax advice, legal advice, or financial advice. We do have referral partners for those various avenues, but I do implore you to consult with your own team and build your own network so that you're comfortable and confident into any investment strategy you may be pursuing and specific investments you may choose to place your money into. Everything I'm going to talk about here is strictly for educational purposes. So again, please take this as an educational component and move forward with that to conduct your own due diligence, build or access your own team, and move forward with the investments that you deem necessary. So what is a self-directed IRA? A lot of people think they have a self-directed IRA when they're with a fiduciary or a financial advisor type company, where they just have a list of assets on the publicly traded market, stocks, bonds, mutual funds, that they're allowed to choose from. Well, technically, that is not a truly self-directed account. A truly self-directed account is one where you can invest into any asset you may want to without someone else being an overseer of that and telling you yes or no regarding the investment strategy. Someone did just post, is anyone else having issues with audio? I do want to clarify that. So if anyone else can add to the chat, if you're hearing me clearly, I greatly appreciate that, just so I know and can edit it accordingly before I get too far into the webinar. Until I hear back, I will keep going. But again, please, if you're listening and you're hearing me clearly or not, just post into the questions box so I can get a good gauge and adjust as needed. So again, self-directed accounts are ones where you can invest into any asset class you so choose, as long as it falls within the IRS rules and regulations, which I will cover thoroughly in this webinar. But it's a very broad scope. The IRS is pretty conveniently relaxed as to what asset classes you can hold. It's easier for me to honestly to tell you what you can't invest into than what you can. But again, I'm going to cover that a little bit later down the line. A lot of people have not heard about self-directed retirement accounts, and that is very common. Only about 4% of US-based retirement accounts are self-directed. And in the grand scheme of things, the total market of US-based retirement accounts, I'm talking IRAs, 401ks, anything that is a tax-sheltered retirement account in the US, there's about 40 trillion, just under 40 trillion with a T, dollars in US-based retirement accounts. So of that, only roughly 1.5 trillion, or roughly 4%, are currently being self-directed. That's not because it's significantly riskier or harder to find than the common investment strategies. It's just that not a lot of people know it exists. And when you do find out it exists, if you reach out to your fiduciary or financial advisor, a lot of that times they shy you away from these strategies. Obviously, they want you to keep your money with them and using their guidance that they charge you for in order to build your net worth, but sometimes that may fluctuate. Sometimes the market may be down. So it's a great diversification tool for people just trying to spread their wealth and their nest egg around. If you're an uber entrepreneurial driven investor, it may be a great tool to switch all of your investments over. I'm not here to sway you one way or another, just here to kind of provide the information and expertise that I have in this industry to let you take it and move forward with it as you see fit. Someone did post that they can hear me clearly, so hopefully the person that was having audio issues is able to get that sorted out, maybe sign off, sign back in. I'm not sure exactly where that may be the issue. So self-directed plans are not just your regular IRA. A lot of people are familiar with your traditional and Roth IRAs. Those are tax deferred and post-tax options that do not have to be tied to an employer. Anyone in the US can have an IRA account. You can only contribute into it based on your ordinary earned income, but anyone can have one. The other types of plans that we offer for self-direction include some employer-sponsored plans like the SEP IRA and Simple IRA for small business owners, an individual K plan or a solo 401k, which is a plan for small business owners with no rank and file employees. So if you have a business where maybe just you and your spouse are the only operators, the solo 401k plan would be a great option for you. And then health savings and education savings accounts can also be self-directed. If you have a 401k plan from a former employer, you can very easily, without tax consequence, roll that money over into a self-direct account. And sometimes even with a current employer, you can do that. The key specific point to make there is that with a current employer plan, you do have to verify you're eligible for what's called an in-service rollover. In layman's terms, all that means is you've got a big piece of turkey, right? And you want to break off a leg of that turkey and move it over into a self-direct strategy. The act of breaking that leg off and taking some of the meat to put into another pot is called an in-service rollover. That is determined between your employer and the retirement account company they're using. So it's a case-by-case basis. It's not black and white for every single person. If you're not sure, reach out to your employer or reach out to your retirement company and ask if you can do an in-service rollover. If you need help having those questions posed, feel free to reach out to me. I am very happy to express those questions and help you coordinate and get those answers. So why do people choose to self-direct? Well, when they find out that this even exists, a lot of people determine it's a new source of capital to place into some investment strategies they've already been doing maybe with their savings or other monies. A lot of people are getting fatigued with the stock market, as I referenced a few slides ago. Some people just don't like the upturn and downturn and maybe the promise that the market's going to go back up. Well, if that's your case, maybe diversifying is a good idea for you. And then the third reason that people commonly choose to self-direct is the inherent tax benefits of making these investments with a tax sheltered account so that your income that you're generating is either being built on a tax deferred basis, meaning you do pay taxes on it later in life when you take it out of the retirement account, or a completely tax-free basis, meaning you have already paid the taxes on the money you put into the account. It grows completely tax-free, and you don't have to pay taxes on it when you distribute it out later in life. That is, in other words, a Roth account. You can have a Roth IRA, and you can also have Roth component within your 401k plan. So those are just some considerations to be had. Some other tax benefits: when you're doing real estate investing with a retirement account, it is not subject to capital gains tax, and some other things that may be applicable are not necessarily applicable through a retirement account. Likewise, a lot of times if your strategy deals with depreciation or bonus depreciation, you're kind of giving up some of those benefits in exchange for the benefits garnered to you with the retirement account strategies. So the biggest benefit to using a self-directed IRA is that you can invest in what you know best. A lot of our clients are real estate investors, whether they're buying physical property and holding rental property or doing fix and flip real estate. Also, syndication investing or limited partnership investing is a key component that we see a lot of our clients utilize. But in any event, if you have some specific expertise or knowledge in investment strategies that you've been doing well with, it's likely you can do that with your retirement account. You just need to know a little bit about the common structures and how to get that coordinated, which again is our expertise and my specific knowledge base. So that's what I'm here to explain and bring to the table so that you can take some notes and walk away with a better insight into how to put your dollars to work for you, both in something you appreciate and cherish as a valued asset, not just, oh, my retirement account holds XYZ stock. I hope it does well. I hope they continue to grow. So some of the more unique investments we've ever seen, aside from, again, just your standard real estate investment or just buying a stock or a bond, we've seen people use these accounts for cryptocurrency, specifically over the past few years, farmland or raw land or timber acreage, even farm animals, some carrier vehicles or some larger automotive type vehicles. There are some caveats there I'll go over further. Investing into sports teams. I've seen a client of mine invest into a pretty large internationally known soccer team, which is a really cool investment. I was really happy to see and watch go through the actions. A movie project, so you can actually use your retirement account to help produce a movie. And burial crypts, which again, we're talking about the retirement account industry, so we do have to be cognizant of mortality, but burial crypts, we'll cover that later, can be held in your retirement account. So I'm going to start with cryptocurrency. When we're talking about cryptocurrency, the easiest way to do a cryptocurrency investment with your retirement dollars is by way of what's called a checkbook control LLC. We also often refer to this as a single member LLC or checkbook IRA. All that is in itself is a strategy where you use your IRA account or 401k to invest into an LLC entity that is wholly owned by that retirement account, and you and or any other appointees are the managers. So you set up a bank account, you provide the operating agreement, we execute an investment into that LLC, and from there you have checkbook control, whether that's a debit card or a physical checkbook, to make investments as you see fit. In this case, once you have that LLC funded, you can go to whatever trading platform you'd like. Most of them at this point are allowing your LLC to make an investment onto their platform, or even if you needed to, hold a cold storage wallet in the name of your LLC to invest into those digital currencies. Investing directly through your IRA can be done as well. We have a few partners that we have in the cryptocurrency space that are particularly set up for us to just have a direct investment. If you're going that route, typically you're going to see your assets held in the name of your retirement account, which as an example here is going to look something like Advanta IRA for the benefit of your name and then your account number. For anonymity purposes, you can redact your name or your account number, but one or the other has to be displayed on that accurate vesting for the retirement account. Farmland and animals. We've seen people invest, if they're into the farm space, into cattle or thoroughbred racehorses, both for racing and breeding rights or even selling for the meat. Those are different things that can be held in your retirement account. We've seen people in the bull riding space invest into bull semen for reselling with their retirement account. We've seen loans secured by alpacas. So you can issue a loan to somebody, and if they default on that loan, you can claim their farm animals as, as a security instrument. Farmland in itself can be purchased for the lease to local farmers to actually farm on the land and generate crops and cut the crops and sell them. Depending on your structure there, you can just lease the land outright, and what you're receiving in return is the rental income. Or you can structure it as a joint venture as well, where you own the land, you lease it to that farmer. After they harvest and generate profits, they share the profits with you based on that joint venture agreement. It's important to note that you set the terms of that type of joint venture agreement and or the lease. So we're not here to tell you how much you need to charge in rent. We're not here to tell you how much you need to split of those profits. That is completely between you and your partner or your leasee as to what terms you generate. Again, this is self-direction, so a lot of the power is in your hands here. A little bit further into the raw land space, we've seen people invest into private offerings for vineyards. So you can be a limited partner or a shareholder in a vineyard, whether that's locally in the US or internationally. So yes, you can take your retirement dollars international. There's some specific caveats there. I'd be happy to speak with you about if you're interested in taking your retirement dollars internationally. We've also put out other webinars in the past on international investing, so feel free to check that out on Advanta IRA's YouTube page. We've seen investments into farmland leased to vineyards, so kind of comparing both of the aspects I just went over here and from the previous slide. Clients familiar with forestry, so timber farmers basically have used their retirement account to buy large chunks of raw land, let that timber be produced off of the land, and then they receive the profits from the sale of the timber. There's some caveats as far as that forester or timber farmer doing the work themselves, and I'll go over that later when I cover the IRS's rules and regulations. And then raw land in itself can be held for camping, anything really, as long as you're not personally utilizing the property while it's in your retirement account. The land in itself can be owned. As long as you're generating enough income or have enough balance in your retirement account to pay the annual taxes, you're ideally trying to draw a net profit out of this property of passive income. But even if it sits steady or loses some, ideally, in theory, the property will appreciate over time. So diving a little bit deeper into some other businesses and the sports club strategy I went over, you can invest into a larger LLC entity, so not the checkbook IRA or single member LLC strategy I referenced earlier, but a larger LLC that's been set up. Maybe a collective of people that you know are looking to set up an LLC and pool all their money together to hold a larger ownership share in a bigger entity. For example, a sports club. Other ideas for that could be investing into a brewery, a coffee shop, and we've even seen a company that produces healthy baked goods that I've seen in my local grocery stores, and seeing it on the shelf in a grocery store is pretty cool. And I know, hey, a client of mine is a part owner in that company through their retirement account. Limited partnerships or complete ownership in different assets like laundromats or car washes, self-storage. The key component here is those businesses, if you're a complete owner, really should not have any employees. So it should be something like a laundromat or a car wash or self-storage where you don't have an on-site staff or W-2 wage earner. It should be kind of again, retirement investments in themselves are set up to generate passive income. So whatever type of business that you're interested in, as long as you fall into those criteria, it's again likely you can hold it in your retirement account. And a really unique one we've seen is a client owning an RV lot within a nudist community. So, sure. As far as transportation, I've seen clients use their retirement account to own transportation vehicles. So if a non-client has a transportation business with a contract to move some vehicles and they need more carriers, a retirement account can own a carrier and lease that vehicle to the non-account holder to basically transport, and the returns generated flow right back into the retirement account. The driver of this transport vehicle cannot be the retirement account holder. I know I'm going to cover the actual rules a little bit later, but as I'm explaining these, I'm just giving you a little bit of information just to make sure as you're digesting and taking in some of these ideas, you're at least at the outset also getting some of the restrictions around them as well. So again, an 18-wheeler mechanic found a truck at a discount. He purchased it through his retirement account, paid a third party to do the mechanic repairs needed, and then sold it for a profit. That's perfectly allowable within a retirement account. And in that case, it was just lucky that that retirement account holder had an expertise in 18-wheelers. Maybe he knew a friend that was not a disqualified person. That's the reference to third-party mechanic that was able to do the labor at a fair market rate and generated a good profit. Another unique investment we've seen is a retirement account holder purchasing a airplane. So the airplane was purchased. It was flown to a storage space by a non-disqualified pilot. From there, it was listed for sale on whatever channels or markets are appropriate for airplanes. And then once it was sold, the buyer went straight to the storage facility, the airport or the airfield, picked it up, and the funds were generated back into the retirement account, either tax deferred or tax free. The account holder, again, was not able to fly in the plane themselves or do any labor on the plane themselves. So it's really just a buy, hold or improve, and then sell for profit strategy there. And then looking really outside the box, literally speaking, you can own a burial crypt in your retirement account. This is something that is deeded like real estate. So deed of title is held in the name of the retirement account. We've had a client find a valuable plot side by side. They were selling at a premium, but they were able to purchase them at a discount and then sell them for a profit to a non-disqualified person. This is not something where you should be buying the crypts or burial plots in your retirement account with intention to be buried in them yourself. That kind of toes a line with the IRS's rule if you're only holding it in your retirement account with the intent and purpose of using personally. I'll cover that a little bit more thoroughly as I go into the rules and regulations here on our next slide. So as I led on earlier, the IRS is pretty easy to understand regarding what you can and cannot invest into and who you cannot and can invest with. So as far as asset classes, the only assets you're not allowed to invest into with your retirement account are life insurance policies and hard to value collectibles like antiques, fine wine, artwork. In other words, anything that the IRS would consider to be subjective in value is something they don't want you to hold in your retirement account. One of my favorite examples is I've got a neighbor up the street, and my neighbor up the street has an old, rusty, non-moving 70s Corvette in their driveway. While that neighbor may be a car nut and thinks, oh, with a little bit of elbow grease, this thing can get up and running and sell for a high profit. It's a highly desired model year and vehicle. That's subjective because as of right now, it's a rust bucket collecting dust, and the IRS doesn't want to see those types of things in your retirement account. There are some currencies that are not allowed to be invested into, but also some that are typically non-circulating currencies you can hold in your retirement account. Precious metals like silver bullion, gold eagle, those can be held. That's a separate, lesser utilized to my knowledge and experience asset class. But if you're interested in precious metals or currencies, feel free to check out our content on that or reach out to me directly. I can point you straight in the direction of that content. So that covers it. Anything else not of those categories, you can hold in your retirement account. You just need to speak with someone like Advanta IRA that can help you understand the structure and the best way to hold it. The next thing that the IRS does to restrict your use of a retirement account is just labeling certain relatives to you as disqualified persons. You're not allowed to transact between a disqualified person, meaning I want to buy something from a disqualified person, or I want to sell something to a disqualified person, or I want to let a disqualified person benefit or utilize an asset held in my retirement account. Those are all not allowed. I'll cover exactly who and what disqualified persons are in a few slides as well. But just for general context, it's very, very close relatives to you. So your distant relatives, your aunts, uncles, cousins, they're okay. And also it is okay to partner with disqualified persons. So think about it. If you're on a deal table, if you're sitting on one side of a table and the people you're doing the deal with are on the other side of the table, as long as your disqualified persons are on the same side of the table as you, it's perfectly allowable. They cannot be on the other side of the table from you. UBIT and UDFI tax are something you should know about. It may not apply to your specific investment scenarios, but basically unrelated business income tax, or UBIT, applies when the passive income generating asset that you hold in your retirement account starts to generate some not so passive income. Unrelated debt finance income, or UDFI, applies when you utilize leverage with your retirement account, so borrowing power, and it's a tax that's levied on the percentage of the investment that is leveraged. Those are some pretty specific aspects of the grand scheme of retirement account investing. We've got some really great content that hyper focuses on those. So if you think your strategy is going to toe into the line of UBIT or UDFI, you can check out that content, reach out to me again if you want a direct link and quick access point to those types of resources. I alluded to it earlier, but I really want to bring home how easy it is to get these types of accounts funded. So the two key ways, aside from a new contribution, placing brand new earned income into a retirement account, the two key ways that people fund these types of accounts are by transferring from existing account of the same type. So your traditional IRA with a managed company to a self-directed traditional IRA, or a Roth IRA to a self-directed Roth IRA. It's a very simple process. The full technical term there is a custodian to custodian transfer. That's always facilitated by filling out a transfer form with the party you'd like to receive your funds. They submit that to the party that's currently holding your funds. And usually that's all facilitated within roughly a week. A lot of times the funds will be wired within a few business days. Sometimes the company currently holding your money has a few extra hoops to jump through, which may include having to receive original documentation, meaning you'll have to sign the transfer form, mail it to our office so we can countersign it, and then we have to mail it along to your current company to get it under processing. So again, just the lead time of the mail there adds to the timeline of getting the account funded. Sometimes there's also what's called a medallion guarantee that's required, which is basically a notary in the finance world. It's something we can accomplish and accommodate at Advanta, but in order to do so, we do need to receive the original transfer form, the wet ink form in our office, and a statement from the account you're trying to pull the money from. The other way that these accounts are funded are via rollover, and a rollover can be done two different ways, a direct rollover or an indirect rollover. Most people do a direct rollover, and all that means is you're taking funds out of an employer-sponsored plan, whether that's a previous employer plan that you can access no matter what, as I referenced earlier, or a current employer-sponsored plan that you can access if you're eligible for an in-service rollover. But as long as you make those funds payable directly to your new retirement account, that's called a direct rollover. You can do that as frequently as you want, as many times for whatever dollar amount you'd like. It's perfectly allowed. It does generate some tax reporting, but as long as the amount you take out of Plan A is the amount you roll into Plan B, there's no tax consequence. It just gets documented to the IRS on the way in and the way out, and it's a complete wash from a tax liability perspective. Now, the other option that's less utilized is called an indirect rollover, and what that means is you're taking the money out of a qualified plan, you're going to hold on to it personally or have it sent to you personally. And the rule there is you have 60 days from constructive receipt. Constructive receipt means you have a check in your mailbox or a wire or an ACH just hit your bank account. You have 60 days from that point to roll the funds into a qualified plan so that you can avoid the tax consequence. If you do that, again, those two documents, which just to be technical, the distribution is reported to the IRS on Form 1099-R, and the rollover into the other qualified plan is reported to the IRS on Form 5498. So as long as those two amounts match, it's a wash. If maybe you do an indirect rollover and don't roll the full amount into a qualified plan, you will have a tax liability for the amount you keep personally, which makes sense. If you're not going to put all of the money back in, the IRS is going to identify what you don't put in, and you're going to be taxed for it. If it was a traditional, if it was a Roth component, there's really no tax to be had, but there may be some other circumstances involved there. They're nuanced and specific to that scenario or situation. The rollovers tend to take a little bit longer because in most case scenarios, rollovers are not sent via wire. Most of the time, if you initiate a distribution for rollover, that company is going to cut a check and either mail a check to you directly, which you have to forward along to our office for deposit, or likely and hopefully they'll mail the check directly to our office. It's already made payable to the retirement account you set up, and we get that under deposit as soon as we receive it. But again, just to make sure we all understand, it's very simple. Typically, at most, takes about a week and a half to 2 weeks to get your account funded. There's usually no tax consequence, and unless you decide to do a Roth conversion or you decide to do an indirect rollover and not roll over the full amount. Otherwise, it's sometimes not even a reportable event in the way of a transfer, or reportable but not a tax consequence in the context of rollovers. So disqualified persons. It's basically, if you look at your family tree and you look at the main trunk, that's what we're talking about. Yourself and your spouse, your parents, your grandparents, as old as are still alive, and your children, your grandchildren, and as young as are alive or you see to live. Those are disqualified persons. And an extension of that is any businesses that they own or control 50% or more stake in. So if they own a business and they make day-to-day decisions or have a majority share in, you should not be transacting with those entities or those people. Again, you can sit on the same side of the table and do a deal with them as partners, but not against them or through them as far as buying or selling, leasing, renting, etc. So now that I've covered some of unique investments, some of the rules and regulations, just to kind of outline the structures that work for most investments. We see LLCs and private placements, and then loans with more creative opportunities based on the security instrument to the loan, some other terms that you can set within the loan agreement, and maybe joint venture type agreements where you get some sort of benefit based on what you're lending or what you're providing as value from your retirement account to the person you're doing the transaction with. Be aware of prohibited transactions and disqualified persons, and then be aware of the possible tax liability when you're utilizing debt instruments or what type of business activity the investment you make is actually conducting. Again, UBIT and UDFI comes into play not on the investment income, it comes into play with the business income that's derived from the asset. It can apply to private equity investments. So if you're looking at syndication investments for your retirement account, make sure you express to the syndicator team or the general partnership team that you're looking to invest with your retirement account, and try to verify how that may affect the grand scheme of your investment and the returns. They should have an understanding or an expectation of how to answer those questions and assist you with that. But again, we're here as a resource as well. I do see a few questions come in. I'm going to address those real quickly. So brothers, cousins, and in-laws are not disqualified persons. Brothers are not disqualified. Cousins are not disqualified. In-laws, it's kind of a gray area for in-laws. Here's an example. If my father-in-law were to want to buy the property that my wife and I live in, my wife is his daughter, so that's a disqualified nature rule. Let's just say my mother marries a gentleman after I'm a grown adult, and that gentleman has never supported me financially, is not my father in any context, but by way of law, he is my father-in-law. Well, that's kind of a gray area where, with further legal opinion and expertise, you may be able to do the deal with that individual. So hopefully that answer kind of clears some of the air. It does leave a question out there depending on what your in-law situation may be, but hopefully that gives you enough of an explanation. And again, depending on the scenario and the in-law in question, seek further legal counsel so that you have all your ducks in a row and you're all squared away before you entertain that investment specifically. The next question I see here, I have a checkbook IRA set up through Advanta. If I want to move more funds from my Fidelity IRA into my checkbook IRA, can the funds be directed from Fidelity to my checkbook IRA LLC, or does the money need to go through Advanta? That is a great question. We deal with that question a lot. The answer is that it does need to flow through Advanta. For proper documentation and record keeping purposes, we do need to take in the funds first into your retirement account with us so that we can properly convey them into the LLC owned by your retirement account with us. If it flows from Fidelity straight into your LLC, you're not going to get the proper documentation and record keeping of the custodian to custodian transfer that I referenced earlier. So that's the basic principle, is that the LLC is your investment vehicle. So you shouldn't be moving money from a completely different IRA into a specific vehicle without it first going through the new retirement account custodian, or Advanta IRA in this scenario. And again, just a quick reminder, if you guys have questions, please add them to the question box. I am towards the end of the presentation, so I want to make sure if you're sitting here and want to ask me anything in particular in this group session, please feel free to do so. Otherwise, again, you'll have my contact information and you can reach out. If you're an existing client of ours, just reach your client account manager, or if you're interested in other aspects or learning more to maybe become a client, you can reach me directly. So some key takeaway points that I want to make sure that I express to our audience today is that your retirement investments can be unique, personalized, and creative. They're not just stocks, bonds, and mutual funds like you maybe thought were the only options available to you. You can use whatever expertise you have and whatever interests you have and place your money into those types of things to really have more vested interest in the growth of your nest egg. Conduct your due diligence thoroughly. You're ultimately in control with self-direction. That's why it's called self-directed. So you're driving. No one is over your shoulder saying, hey, that's a good idea. Hey, that's a bad idea. Unless you put those people there by building your team, as I referenced earlier, of trusted CPAs, attorneys, financial advisors, etc. But make sure you're comfortable and confident with that team, because when the deal you make does well, you are the one that gets to cherish that and benefit from that. If it doesn't do so well, you're also the one that has to understand and realize, okay, that was my decision. I completely made that investment thinking I understood the consequences and everything. So make sure you're fully aware of the best positive side of the investment you want to make, and also the potential negative outcomes if it were not to go as planned. And then the third takeaway point here, diversifying your retirement portfolio can help protect your nest egg during unstable market fluctuation or the real estate bubble. So this is not an all or nothing strategy. It can be exactly how you want and need the strategy to be. You can keep a retirement account over with a managed custodian and move over some funds to self-direct and let that money flow back and forth. As long as it's cash, it can flow back and forth via transfer as frequently or infrequently as you want it to. If you enjoyed this, I do want to share with you that we do have a very robust catalog of educational content. We typically put on 2 of these educational webinars a week on Tuesdays and Thursdays from 12 noon to 1 p.m. Eastern Time. We also have a video library of all our recorded webinars on YouTube. So youtube.com/Advanta IRA. You'll find years and years of educational content. Often we bring on guest speakers with specific expertises in various industries. So check those out at your convenience. And if you're interested in some of the more industry standard news and updates, we are going into an election year, and there's often various aspects in the legislation that affect the retirement account industry. You can follow our blog on our website as well. That's advantaira.com. Here is my contact information that I'll leave up on the slide for just another moment or two as we conclude. If you have any questions, now would be the final call to ask them. Otherwise, I'll give it about another 60 seconds or so, and then I will end the session. I hope you all had a great day. I hope you walk away with something beneficial from today's webinar. Reach me if you need anything further, and we're always here to help. Thank you so much.